Ever wondered how companies go public? It's a process known as initial public offering, or IPO. Now, you might be asking, what exactly is an IPO? Well, an initial public offering, or an IPO, is the first sale of stock by a company to the public. Prior to an IPO, a company is considered private. With a limited number of shareholders, these private companies are not required to disclose as much information as public companies. But why would a company decide to go public? There are several reasons. One of the most common is to raise capital. By selling shares to the public, a company can generate funds to invest in new projects, pay off debt, or expand its operations. Another reason is increased market exposure. When a company goes public, it often receives a lot more attention from the public and the media. This can help to boost its profile and reputation, making it easier to attract new customers and business partners. Going public also makes it possible for a company to attract top talent. With publicly traded shares, a company can offer stock options as part of its compensation package. This can be a powerful tool for attracting and retaining the best employees. But going public isn't all rosy. It also comes with its share of challenges and risks. For one, it can be a costly and time-consuming process. There's also the risk of losing control. When a company goes public, it has to answer to its shareholders. This means that the company's leaders can't make decisions as freely as they could when the company was private. In addition, going public means more regulatory scrutiny. Public companies have to comply with a host of regulations and are required to disclose a lot more information than private companies. This can put a lot of pressure on the company. Now that we know what an IPO is and why a company might go public, let's dive into the step-by-step process. The first step in the IPO process is choosing an investment bank, also known as an underwriter. Now, the underwriter plays a pivotal role in the IPO journey. It's essentially the financial whiz kid who takes on the mammoth task of valuing the company, setting the IPO price, and selling the shares to the public. Think of it as the company's guide, navigating through the rough and tumble of the stock market terrain. When a company is deciding on an underwriter, there are several factors to consider. The reputation of the bank, its industry expertise, and its distribution capabilities are all important. It's like choosing a partner for a high-stakes dance. You want someone with the right moves, someone who knows the routine, and someone who can help you shine on the dance floor. Once the underwriter is on board, the real work begins. The second step in the IPO process is due diligence and registration. Now, what does due diligence mean? It's akin to a thorough health checkup for the company. This process involves a deep dive into the company's financial health, operations, and market positioning. It's like peeling back the layers of an onion to understand the core of the business. Financial auditors, legal experts, and business analysts meticulously examine everything, from balance sheets and contracts to intellectual property and human resources. The aim here is twofold. First, it ensures that the company is in good standing, free from any hidden liabilities or dubious practices. And second, it helps ascertain a fair valuation for the company, a critical factor for pricing the shares for the IPO. But the due diligence process is just half the story. The next phase is registration, which is pivotal in the IPO journey. This step involves drafting a document known as a prospectus. Think of it as a detailed map of the company's journey so far and the road ahead. It includes everything from the company's financials, its business model, to the risks and opportunities it faces, and the intended use of the IPO proceeds. This document is critical as it provides potential investors with a comprehensive view of the company, helping them make an informed decision. But creating a prospectus is not a solo act. The company works closely with its underwriters, legal team, and auditors to ensure the document is accurate, transparent, and compliant with all necessary regulations. Once the prospectus is ready, it's submitted to the Securities and Exchange Commission, or SEC, for review. The SEC, acting as the gatekeeper, reviews the prospectus to ensure it's in line with the regulatory requirements. This step is not a quick one. It involves a rigorous back and forth with the SEC until all the requirements are met and the prospectus is approved. With due diligence complete and the registration filed, the company is one step closer to going public. This stage is a crucial milestone on the road to an IPO, laying the foundation for the exciting steps ahead. After the registration is complete, the company and the underwriter embark on a roadshow. Now, you might be wondering, what's this roadshow all about? Well, it's not a literal journey on the road, but rather a metaphorical one. It's a series of presentations made by the company's management to potential investors. The roadshow is a crucial step in the IPO process. It's the company's chance to make a lasting impression, to tell its story, to showcase its potential. It's all about drumming up interest and convincing these potential investors that this company is worth their time and, more importantly, their money. Picture a charismatic CEO, confidently striding onto the stage in front of a room full of investors. They weave a compelling narrative about the company's past successes, its current position and its future prospects. They answer tough questions with grace and poise, reinforcing the investors' confidence in the company's leadership. But the roadshow isn't just about storytelling. It's also a critical opportunity for the company to gauge the level of interest in its shares. This feedback will help determine the final IPO price. Yes, the company and the underwriter will decide on the final price of the shares based on the demand they perceive during the roadshow. Once the final price is set, the company is ready for the final steps. The shares are then listed on a stock exchange, and the company officially becomes public. This means that anyone can buy a piece of the company, and the company can raise capital from a broad base of investors. It's a transformative moment for the company. It's like a coming-of-age ceremony where the company steps out of the shadows of being private and steps into the limelight of the public domain. It's a step that requires a lot of preparation and hard work, but it's also a step that can open doors to new opportunities and possibilities. And just like that, a company goes from private to public. The IPO process is complex, but it's a vital part of our global economy. So, to recap, the IPO process involves several key steps. First, the company chooses an underwriter to guide them through the process. Then they undergo rigorous due diligence and registration, ensuring everything is in order. Following this, the roadshow takes place, where the company promotes its shares to potential investors. Finally, the company goes public, selling its shares on the open market. Now, next time you hear about a company going public, you'll understand exactly what that means. Thanks for tuning in.